This is Dan Dix here reporting for Press for Truth, coming at you here with a fair warning today, my friends. As you can tell by the title of this video, be warned. The Silicon Valley banking collapse is just the beginning of something much, much larger to come. Now, if you're just hearing about this now, the second largest bank in the history of US banks to financially collapse just happened. This is Silicon Valley Bank. There's only been one other bank larger than it to financially collapse in the US. This happened back in the 2008 financial crisis. And now we have SVB. And, you know, I could spend a whole day talking about all the factors that led up to this happening. And indeed, a lot of people are pointing the fingers all over the place. Most people are claiming that this is a result of the Fed raising interest rates over the past year, causing a lot of the, depositors to not be able to make payments and therefore leading to this run on the bank. But I would disagree. I would say if you are taking out massive loans at artificially low interest rates, when rates are at almost zero, and you're like, oh, things are good, and you keep taking out loans, you should know that there's an inherent risk in what you're doing, and that the Fed, like I always explain, are like, old skinny bones in their fingers wrapped around your neck that can squeeze at any time they want. So the blame can't be essentially put directly on the Fed in the raising of interest rates, and morally, more squarely on, poor risk management from these depositors. Now, SVB is not your average bank. In the US, because of the system of fractional reserve lending, which we'll talk about, they have a system where depositors can be insured of up to $250,000, in the case of, a bank run ever happening there, that they can be sure that they would get their money back up to $250K. Now, for most banks and most people, this is going to work for them to be able to stave off a bank run, because most banks out there don't have depositors with that much money. Most people have, I don't know, a couple $1,000, maybe just a couple $100 in their bank account. Maybe on average, most banks have depositors with a couple grand up to like maybe $30,000, $40,000, $50,000. Most people don't have $250,000 in there. Now, the San Francisco Valley Bank is very, very different. Silicon Valley in San Francisco. This is filled with venture capital firms, tech companies, and startups. So we're talking millions of dollars, billions of dollars are in there at this bank from these depositors. And as I said, I could spend a lot of time talking about the ins and outs of why this happened, but I want to, for the purposes of this video, talk a little bit about the fact that it was not only known that this would happen, but it is in fact by design. Now, we know that it was known that it was going to happen, namely because some of the key players involved, the CMO, the CFO, the CEO, all these guys started withdrawing funds like a couple of weeks ago. Just before the start of this collapse, all the major guys involved started selling off their stock to the tunes of millions of dollars before this happened. So if that wasn't a sign that some people knew what was coming, I don't know what is. But as I said, I want to talk a little bit about the fact that this is by design, and the only way for these artificial bubbles to decrease is to fully pop. And as I said, this is all by design. So in order for us to understand how these future financial pops might happen, we have to understand the history of fractional reserve lending and where this all can be charted back to. And yes, you can chart this all the way back to the Rothschild banking dynasty, who really fast-tracked and innovated on the fractional lending process and brought it to an international level. And we'll talk about that. even before we get there, you could take it back even 1,000 years before that, to the time when money was gold and silver. Physical, tangible, precious metals is what people would trade in the open marketplace. And the goldsmiths at the time were the only ones who had the vaults where you could store your physical gold and silver. So the goldsmiths offered this service, you know, at a small fee, and that's fine. You know, they were providing a service. They had to build the vault. So people would start putting their gold and silver in these vaults, and the goldsmiths would return to them a receipt, you know, showing exactly how much was deposited in their vaults, and it's guaranteed by the goldsmiths. Now, what ended up happening, guys, is people don't want to carry around heavy metals in their pockets, so they started using these paper receipts in the open marketplace. So if you wanted to make a transaction with a landowner, you wanted to purchase some land, and he says, yeah, that'll be $20,000, you know, back then. And you say, well, instead of me going to my goldsmith guy, getting it out, giving it to you only so you could go put it back in there, because I know that's what you're gonna do, why don't I just give you this note, which you know is good, for $20,000. I'll sign it over to you, and you can have that. And that's what people started doing, and that's how essentially paper money began. You know, most people started transacting in this way, and it was around that time that the goldsmiths discovered something major. They realized that the majority of people, they don't come and show up to get their gold taken out. They do what everybody else does. They use the paper receipts to continue transacting within the marketplace, and they just leave the gold in there. And so these sly, sneaky goldsmiths realized this, and they discovered and realized, hey, we could just start issuing out receipts for gold that we don't even have in there, and charge people our fee on that, and they wouldn't know. Nobody would be the wiser. How could they possibly know? In fact, they realized the only way that anyone would ever figure this out is if they all showed up on the exact same day to get their gold out at the exact same time. But the goldsmiths back then knew that just doesn't happen. That's never going to happen. So for hundreds of years, they were able to amass their wealth in this way. And then along came a man who was like a wizard of fractional reserve lending. He had a son that was named Amshel Bauer. And his son Amshel Bauer was particularly brilliant in the practice of money lending that his father taught him. And his father, when he had this bank growing up, he put this like red shield on the front of his little private bank. And that's where Mayor Amshel Bauer grew up. Now, as I said, he was particularly brilliant. He realized, you know, he took his father's practice a little further, and he started rubbing shoulders with royalty. He made friends with, you know, queens and kings, and eventually he gained the trust of some royalty who lent him some money. At the time, it was the equivalent of around $3 million. And history would show that Mayor Amshel Bauer embezzled this money. He used it to vastly expand his empire, and that was the beginning of his dynasty. And at the time, he decided to change his name to represent the sign that his father put on their very first bank, and that was the red shield. So he changed his name to Rothschild, which is just German for red shield, to honor his father. Now, Mayor Amshel, now Rothschild, no longer Bauer, went on to have a large family. He had 10 children, 5 sons and 5 daughters, and he trained, just like his dad did, all 5 of his sons in the fine art of fractional reserve lending. And he ended up sending his sons, he opened up 5 different banks all over the world, 5 Rothschild banks, and he appointed all 5 of his sons to be the heads of each one of these banks. You know, there was Nathan and Jacob. Nathan Rothschild, for example, was put in charge of heading up the Rothschild Bank of England. And his other 4 sons were placed in other countries around the world. And in this way, he was able to amass a huge amount of wealth, you know, putting his former friends in, you know, kings and queens and royalty to shame when it comes to wealth. these guys eventually turned themselves into trillionaires. So this is where the history of fractional reserve lending stems from, and it still operates like that to this day. Now, Canada's a little bit different than the US. In Canada, the bank was privatized, you know, just like the Federal Reserve, but it was, by the time the 10th Prime Minister of Canada came into power, William Lyon Mackenzie King, he ended up changing everything, and he nationalized the Bank of Canada, essentially putting the power of issuing currency and creating money into the hands of the Canadian people. I believe he did that around 1938 or something. And for years, this is how Canadians operated and became wealthy and were able to eventually, you know, build the infrastructure that is Canada. But then all that changed in the 1970s when Canada decided to join the G7 nations, and Canada started borrowing its money from private offshore banks, private privately owned banks at interest, instead of doing like it had been for decades, borrowing from itself, the Nationalized Bank of Canada. And from that moment, we then entered into this perpetual debt-based system that was the creation of a bubble that was only ever going to continue to inflate, and the only way for it to stop was a complete collapse. That's how it's by design. That's what we're seeing happen today in the financial sector. Now, in case you didn't know, this has affected the stable coin, the cryptocurrency USDC. If you're not familiar with cryptocurrencies or stable coins, this is essentially a cryptocurrency that is pegged to something that is stable, like the dollar. And this is supposed to be a safe haven for, you know, volatility within the markets. But as we've now seen from major cryptocurrency exchanges like Binance and Coinbase, they, in just the last 48 hours, stopped withdrawals of the USDC coin because of the collapse of the Silicon Valley Bank. So not only can the banksters not be trusted, but these, to a large extent, cryptocurrencies and cryptocurrency exchanges cannot be trusted either. So this begs the question, what do I do then? Where do I put my assets? Where do I hold my money? Who can I trust moving forward? And the answer to that is you are the only one you can trust. The financial responsibility of maintaining your assets moving forward is fully going to come down to you and you alone. And some of the ways that you can achieve this is through decentralization. That's the key moving forward. Gold, silver, and Bitcoin, for example, are ways that you can hedge yourself against this, you know, dollar crash, bank runs, and fiat lending run completely amok, you know. And the reason why I say BTC is because the nature of its decentralized nature. There is no central office that can be shut down. You know, it's fully within the power of you to transact. No third party has to be involved. And they're working on breaking this down, you know, and eventually bringing in the global one world digital currency, but Bitcoin's not the one. There are also other stable coins that, believe it or not, are decentralized, like RSV. It's called Reserve. This is a fully decentralized stable coin. These are some of the things that I think people need to look a little more into moving forward. And I mean, beyond that, as I've been saying on this channel for quite some time now, if you're not to the point of having yourself a self-sustainable garden as well, well, you're falling way behind here, ladies and gentlemen. So today's collapse of the Silicon Valley Bank it shouldn't come as a major surprise to Press for Truth viewers, but it should come as a warning that if the second largest bank to financially collapse in the United States could happen within 48 hours, guess what? Most financial institutions can happen in the exact same way, because they too do not hold the collateral. They don't have the deposits that they say they do have. And as soon as people's confidence is fully shaken in that, it's going to create, more bank runs in more banking institutions. So I would stress, don't hold your assets in the bank. And by that, I mean, don't hold dollars. Just put enough in there to pay your bills, and that's it. If you have any kind of access that you are able to play with in terms of your savings, keep it in gold, silver, Bitcoin, and other decentralized assets. Otherwise, you're going to get caught up with the rest of them, like the Silicon Valley banking crowd and the FTX crypto crowd, who got completely wrecked this year. So just wanted to bring all that to your attention today, ladies and gentlemen. Yeah, I mean, like I said, it shouldn't be a surprise to PFT viewers, but again, be fair warned that if you've got your current assets held up in the bank, they're not yours. If you have any crypto that's held up on an exchange, not your private keys, not your coins. Remember that, guys. Protect your assets moving forward. Just wanted to bring all that to your attention. Don't forget to click the thumbs up button and share this video with your friends and family who you think need to see it the most. Help them protect themselves, get their assets out of the bank, out of the dollar, and into these assets that have been proven to be a hedge against not only hyperinflation and things like that, but certainly runs on the bank as well. So just wanted to bring all that to your attention, guys. Don't forget to click that thumbs up button, share this video with your friends and family who you think need to see it the most, and stay tuned. We're going to have more video reports coming very soon. This is Dan Dix reporting for Press for Truth. We all want truth. The truth will set you free.